Yeah, we're good to go.
Awesome. Awesome. Well, let's see. Got people joining in here. That's good. All right, so welcome everybody. I'm so excited. Richard, did you have anything you wanted to start with, or do you want to wait a few moments for people to join us?
I don't have anything to start out with. I think we're all good to go. Everybody should be funneling in here.
Super. So the first thing I want to do is thank you all very much for tapping back in here. I'm very excited about this class. It's going to be fun. I have two speakers today. I have Pam Reynolds, who works with Josh Hummer. He was our attorney that helped us out last week in understanding some of the legal changes that we will face. And then I have Pam Jones. Oh, excuse me. Let me go back to Pam Reynolds. Sorry, Pam Jones.
No worries.
Pam is going to speak to us today about alternative housing considerations. So if some of you are thinking about, you know, what your next step is housing wise, Pam's going to enlighten us on things that we should take into consideration. Pam Jones with Long and Foster is, I've worked with her for many, many, many years, too many, more than either one of us want to admit to. And she is a realtor who has tremendous amount of experience in Loudoun and Fairfax County. And she can share with you some ideas that she has as far as real estate holdings as a portion of your wealth. So, and what your options are there. So I'd like to get started. The first thing I'd like to ask, last week we covered, as a matter of fact, I can just get started here. So where do I start? I start with last week in a review. We talked about developing a budget. We talked about getting our ideas on what we need to live on, what will pay our immediate expenses, and what our income stability is. So I just wanted to see if anyone had any questions from last week. Any at all, just raise your hand. Good, all right. So during my part of the presentation, I welcome comments and questions during the presentation. That way we're both talking about the same thing. I would like to ask Pam, do you agree with that? Would you prefer that, or would you prefer people to hold questions towards the end of your presentation?
I'm not sure which Pam you're asking, but I'm okay with either.
Awesome.
Yeah, me too.
Good.
No worries.
No worries at all. We're an open
I'm
book
squared today.
Super. So so what we did last week, and just a quick review, is we identified our income sources. We identified which of our expenses were fixed and which were variable. Remember, we talked about you know, which categories those fall in. We also talked about budgeting for cash positions for emergencies, which help us out tremendously, not only to overcome an emergency, but to keep us from going into debt when we have unexpected expenses. Nobody likes that. So now what I want to do is delve a little bit deeper into the fine print on assets. I'm going to spend a few moments talking about how to define our assets and make sure that we are very, very much aware of all of the specifications and the conditions of our assets and our liabilities. So the first thing is asset location. And many people think when I say that I'm talking about asset allocation, and I'm not. Asset location means where the assets are actually held. Are they held in tax deferred accounts? Are they held in a Roth tax free account, or bonds that are tax free? Are they held in accounts in which you pay capital gains only as opposed to income tax on your income? Are you required to reduce that asset because of your required minimum distribution? So for each of the assets that you have, and when you look at your spreadsheet on your net worth statement, you want to make sure that you know what vehicle those assets are held in. And sometimes it changes. You can have assets that are a brokerage account, for example, that you only pay taxes on capital gains, and then you move that asset to an annuity, and all of a sudden, you know, the taxable income becomes income tax as opposed to capital gains tax. So there's certainly a way that we can shift. We can also take IRA money and move it to a Roth. That changes the tax implications for when we have to utilize that money. So your asset location is a very important discussion to have with yourself and your financial advisor and your tax advisor, because you want to make sure that you are in control of all of that. So the next thing that we talk about is your asset allocation. Your asset allocation means how the pie is divvied up. So you can take your entire portfolio and you should, and make it into one asset allocation table, because this tells you what you're exposed to from the standpoint of safety or risk management. So this isn't necessarily specific to one account. You should think of it as an entire pie, even though you want all, to be aware of what the risk is for each of your investments or your portfolio holdings. And I want to share with you, I found this article, I ran across it, I found it fascinating. Evolving allocation models. So some of us have been investing since when? Since the 80s, maybe. When we invested, we had multiple asset classes to invest in, and we use that to address what we call volatility or risk. So for example, when we buy bonds, we buy them because we think of them as safe. We think of them as not having a lot of flexibility in their pricing or their income. When we buy assets that are higher risk, we know that they're going to go up and down, and that is measurable. And so we want to take a measure of our volatility to determine how much that risk that we are assuming on each of our investments. For an awareness, I'm not saying volatility is bad. I'm just saying that you need to be aware of it, because it's a slippery slope sometimes. And the assets that are the most volatile and have the best years can sometimes take over our portfolio. So in the 1980s, so those of us who remember this, we had three choices for investments, right? We could buy stocks, we could buy bonds, and we could buy cash as non-institutional investors. This is all on our own. And some of our parents, we may recall, would buy 2 or 3 stock positions with every paycheck, or buy EE savings bonds, things of that nature. They were very systematic in how they did this. In the 1990s, we were introduced as individuals to international investing. So now all of a sudden we had available to us international stocks and international bonds, as well as domestic or US bonds, US stock. And we always had cash, right? We could stick money in our cash holdings. So this kind of opened up the world essentially to our investment options. Then in the 2000s, I mean, there was a tremendous amount of regulatory changes, and it allowed us to get into emerging markets, as well as high yield, or what we call junk bonds. You probably remember a couple of movies made about that. When it was first introduced, people thought it was the greatest thing in the world, and they didn't fully appreciate the increased risk. In fact, when we look at an emerging pie chart of all of the different assets that we have, we understood US stocks, US bonds, and cash. It didn't, that we were comfortable with. Now we are investing in many, many different areas that we may not be quite as knowledgeable about. We don't recognize the names of the company. It's not Ford and Coca-Cola and some of the names of companies that things that we used every day, Procter and Gamble, things of that nature. It's gotten a lot more complicated. So I just wanted to bring an awareness there. That means that today, as we continue to evolve and have things available to us as individuals, we can now reach out through trading platforms and buy commodities, buy real estate investment trusts, as well as all of these other options that we have tried to integrate into our portfolios. So really, I think an awareness of the fact that it's tough to be an expert in all of these areas. So the better educated you are, and the more access you have to resources, will give you a certain amount of confidence in making these decisions. So I digress, and I use 3 slides to do it, but I'm ready to move on. Classify retirement income sources and assets is very important. what we want to do is determine a couple of things. First of all, what sources are available to you for income. So we have pensions, we have Social Security, we have part-time jobs, we have rental income. So we want to take all of that into consideration. But for each of those income sources, we want to determine how long will we receive income from that? Do we have a payout that matures at a certain point and stops? This is very important for planning. Pensions ideally don't. Pensions, pay out for the rest of your life. But if you're in a situation where you unfortunately haven't taken that many withdrawals, does your pension go to somebody else? Do you have the option to pass down as a legacy to your surviving family? So that's something you want to know about, because obviously you want your money to grow, you want your payout to grow, but you want to know, if there's any surprises. Does it stop? Does somebody cut the tree down at any point? How reliable is the income source? And this probably wasn't a question I would have even asked until the early 2000s, when some of my clients who worked for airline industries had their pensions shut down. They had to they were bought out from their pensions and given a lump sum. It was terrifying for them because they had planned on having that income for quite a while. So that's something else to really be honest about. How reliable is the income source? I have a client who is very well situated with gifting from certain sources in her family, and it's a wealthy family and it's working out great. But how reliable is that? How long can she expect that to continue? So that's, you obviously want safety above luck. You don't want to have to depend on being lucky in situations like this. What is your cost of living protection? So for each of your income sources that are continuous, do you have a COLA that increases when inflation goes up, when the cost of living goes up, then that factor does? So for example, Social Security is very, very nice in that it does increase and inflate as inflation does. Some of our pensions do, some of them don't. But it's important to know because the costs of goods and services go up. So we want to make sure that the income stream that we have today will continue to meet our needs as our costs rise. Does that make sense? Flexibility of payout options. Here's another thing that we want to consider, especially if we start investing our assets into streams of income, which is not always a bad decision. It's not always a good decision, but we have to know what the rules are. So can we in fact turn on and turn off streams of income? Once we start it, do we have any control over it? Is there a day where it stops? Is it a payout with what we call a period certain, which means it only pays for 10 years or 20 years? Maybe it doesn't start until you're at a certain age. So we want to know how flexible our payout options are so that whenever we have to make those decisions and choose our payouts, we know what all of our options are. So this is a flexible person here. That's pretty clever. My daughter designed these slides, and she's quite a bit younger than I am. And I can tell you, I could probably do this position here, this first one. But risk tolerance versus risk capacity. So let's talk about that for a minute. Many people are very aware of how they react to risk. So for example, when you get your statement and you see at the very top, we talked about reading statements last week. So we open our statement, the block pops up and it says your loss gain is, and sometimes it has parentheses and sometimes it doesn't. How do we feel about that when we see that number? Are we happy when it's up and disappointed when it's down? Are we ecstatic when it's up and just absolutely devastated when it's down? That tells you what your risk tolerance is, because every portfolio that is invested are going to have some points in which they do well and some points in which they haven't responded. Now that doesn't mean, because it's a negative number, that doesn't mean it hasn't done well. So let's talk about that. if we have a year like we've had in the past, and I'll just use the dreaded 2008, where markets were down 35% in 1 year, and it was terrifying for a lot of people. If your portfolio was down 10%, you won, right? I mean, that was like somebody did something right to mitigate my risk. So, so your risk tolerance has to do with how you feel about the jumps up and down, and whether you panic or you celebrate, or if you accept how it's going. Risk capacity is an entirely different concept. Risk capacity is whether you can afford those downturns. So, for example, if you have goals in mind in which you want to leave legacy money, and you want to leave so much to the church and so much to your grandkids, or however you want to do that, then your risk capacity is probably quite large, because you're recognizing that you don't need all of your money to live on, or it's projected that it will outlast you. But if you, on the other hand, are pretty much getting by and taking the smallest withdrawal that you possibly can to make ends meet and to live a lifestyle that you're comfortable with, you don't have a lot of capacity to accept risk, even though you may be very tolerant of it, right? It may not bother you at all, but and you could actually enjoy risk, and you could enjoy speculative investing, but you have to ask yourself, do I really have the capacity for loss? So that's a discussion you need to have with yourself and your advisors, because it's that in the long run will make you feel entirely different about your portfolio. How well will you endure market volatility? Now, our markets are, so when those of us who have kids or grandkids who have entered the job market since, let's say, 2010 or 2011, I mean, that's 10 years of really no down markets. It's pretty unusual to have done, to have had such a bull market so strongly during all the things that we have been through in the last 10 years. So from their limited experience, they may feel like there's no such thing as a bear market or a down market, because they've never experienced it. They've never experienced housing markets going down. They've never experienced their, the cost of their house being less than what they actually owe on it, for example, or loss on any great level. So you have to, fortunately, we have the experience, and we know how well we will endure a market volatility or a market correction. And we also know it's temporary, that we will be back. How much can you afford to lose, again, is directed at risk capacity. So, so your assets and your risk tolerance, the more risk you take, the more opportunity for higher returns, but also the more opportunity for losses. So that brings us up to the point of how we structure our income going forward. And there's three different approaches that I would like to lay out for you. They're by far the most common, and they're essentially income 101 for financial advisors. The flooring method is the first one. The flooring method means that you have a very good understanding of what your expenses are, and all of your income meets your expenses. Then you have to calculate your discretionary income. So your essential needs are met by what you have coming in every month. The rest of your discretionary spending is pulled from your portfolio. So that's whenever you call your broker and you say, okay, please send me over $10,000. I have to buy a new car, or please send me over, deposit to my bank account, $5,000. I want to buy a new appliance for my kitchen. So that's when you can choose, when your portfolio is up, you can choose to do some of the spending, and you can, there's no rush. There's no sense of urgency. We have our emergency fund for that, right? So it's not because our refrigerator is broken. It's because we really, really want a refrigerator that meets our needs this year. So so that's it's a very nice position to be in, and it's something that people on pensions often utilize, is this type of flooring method. Our floor expenses are met, and how do we, what do we spend our discretionary spending on? And those really determine your values. Fixed income with a lower withdrawal rate from your portfolio, because you're only withdrawing whenever you have those, whenever you decide to, essentially, whenever you decide, I want to take money out for this. And you can also use a managed money approach to withdraw from your portfolio on a fixed or many instances annually as you need your RMD, and then decide how that money will be spent. People often use annuities for this too. They often will purchase annuities so that they have money flowing in that meet their expenses. You have to be very, very careful when you purchase an annuity. I think they're wonderful for what they're designed for. But you definitely want to make sure you have a good understanding of all of the rules and expenses and things of that nature. The second approach is what we call the bucket approach. The bucket approach lets you establish multiple portfolios with different time horizons. So that looks like your first portfolio is cash and short-term investments for the first 5 years. So there's no risk here. You know that you can turn that faucet on and you'll probably drain the bucket within 4 to 6 years. There's no guarantee exact amount that it will last you, but that's kind of your goal. Let me pull out of my safest investments for that time period, because my bucket number 2 is designed for income from year 6 to 15, and in it and we're always filling these buckets, right, as we get income and we reinvest. What we're going to do is kind of have more of a conservative, this is a mid-term as opposed to short-term or long-term. This is more of a mid-term investment where we want returns, and we predetermine exactly what our goals are here. So we could say, for our short-term goals, I'm happy with a 1 to 4% return. And my midterm goals, I'd really like to see 6 to 8%. So we're going to invest in those products or those assets that will give us that kind of return. Then our aggressive portfolio, and I use the word aggressive kind of loosely, we know we have 10 to 15 years to grow this, right? So we can be a little more risk tolerant of the assets in this bucket, because as we drain our first bucket, we take the assets from bucket number 2, our second tier, and we pour that into our cash and short-term investments. So we reinvest in things that give us a 1 to 4% return, and then we're set for the next number of years. And we have to look at this every couple of years. Our third aggressive portfolio, we dump then into our second. So we scale down the risk that we're taking with those assets. Then we continue to, on our aggressive portfolio, often it's just growth that we're pouring out of it. So we always have long-term money invested. And then we come to the systematic withdrawal portion of this. A systematic withdrawal is usually an individual who is living off of their portfolio. So they have saved through their lifetime and they have done a tremendous job, but they don't have a lot of fixed income. And so they're dependent on their withdrawal rate from their portfolio to get them through the rest of their life. So what we are looking for here is a sustainable withdrawal rate. That's what you want to spend your time talking to your financial advisor at. If I'm pulling out X number of dollars, what percentage of my portfolio is that, and is it sustainable? We also want to determine what our glide path is, and a glide path is your change in allocation over time, or more simply put, your equity bond relationship. And that's going back to the bucket method. That's changing your allocation to reflect your need for income and how much risk you're willing to take on that. So, and then we also want some very fixed rules on what our income changes are going to be. So let's talk about that a minute. During our retirement income we take retirement income pay cuts during bear markets. So we live a very, very nice lifestyle, and we pull out a withdrawal rate that makes us very comfortable, because we know that if our portfolio value drops, we have to reduce our income a small amount to accommodate that loss of principal. So it's triggered in this instance. This is just an example, but it's triggered when your current withdrawal rate is 20% greater than your initial withdrawal rate. So if we set it at, say, 4% or 5%, if our portfolio goes down and the amount we're taking out is the same, then what happens, the math wise, our withdrawal rate actually goes up, right? Because we're taking out more. So let's talk about that a minute. So portfolio loss the previous year. So we do this year by year. This is not, short-term response or reactiveness to the market. But suppose you have 100,000 and you start withdrawing 7%. So you're taking $7,000 out each year. The market goes down for several years and your portfolio value is now 82,000, and you've taken withdrawals too, right? That same $7,000 withdrawal is now 8.5% of your, now 8.5% is just not a sustainable withdrawal rate. So what we do is we kick in our rules and we say, well, that exceeds 20% difference, the 7 to 8.5%. So we then reduce our current year's withdrawal by 10% of the payout rate. So in this example, your withdrawal would go from 7,000 to 6,300. So this is just an example, obviously, but it's something that you want to structure as rules that your portfolio can sustain. So if your withdrawal rate is greater than 20% above your default or where you started, then you drop your income by about 10%. On the other hand, what we call the prosperity rule is if your portfolio gain in your previous year, same logic, you're withdrawing 7%, but you also have your consumer price index to take into consideration. But the CPI goes up by 3%, and the following year you would increase your withdrawal rate by 3% and take out 72.10. Those are in good years. Or what you can do is say when inflation goes up, your withdrawal rate is greater than the 20% below your default, then you increase your income by 10% to cover that in good years. So you're still market dependent, but you can afford to be, because you've worked out the rules that you're comfortable with. You're just as comfortable with 6,300. It's just a little bit more. It's not the year you go to Paris. So impact, I've got one more minute so I don't cut anybody else off here, but your impact on volatility has to be recognized. Whenever your portfolios are volatile, here's a real quick chart. Whenever you have these dips down for people who are very aggressive investing wise, you've got to dig your way back out before you can start making gains. So in a hypothetical portfolios in which there's lower volatility or lower gains and losses, what happens is you actually end up ahead because you don't have to recover losses. Fiduciary standards are important. Make sure that your advisor goes by fiduciary rules and guidelines. Make sure they always have your best interest when they're advising you. It's very, very important. And don't forget insurance, because insurance can mitigate a great deal of risk. So again, the things that you can insure, make sure that you're getting your money's worth. Don't buy insurance just because someone says it's a good idea. Make sure that it's a practical way to reduce what you consider a big risk to your portfolio. And I think that's it. So unless there's any questions that I can answer, any questions at all? Wow, great. Okay. So what I'd like to do now is turn my portion of the presentation over to Pam Jones with Long and Foster and let her walk us through what she sees in the real estate market for retirees. Pam, you ready?
Yes, I am ready. Here we go, share screen. Okay, well, thank you so much, Linda, for having me today. I really appreciate the opportunity. She's invited me to talk with you today to answer some questions, actually ask you some questions about, your housing needs and offer some advice on the process and suggest resources and alternatives for you as you decide whether to stay in your home or to make a move in retirement. So jumping to slide number 2, here we go, let's move that. All right, we have, my talk is entitled The Value of Home, Retiring Single, the Value of Home. And I've worked out 5 different values for both short and long-term considerations. And you can see them here: emotional value, market value, location value, size and use value, and leverage value. And just to go through each one of those with some ideas for you, some questions to ask yourself. I wrote this as questions to ask yourself. So jumping into emotional value, that's usually the toughest part of making a decision about whether to move or not. And the first one is the history you have with partners, children, family gatherings. What do I remember and how often will these gatherings occur in the future in this home? The note I made here is, do I want to stay here for the right reasons? And can I support this decision physically and financially as I age? I'm going to cover these in a very, probably just a little light manner, but I want you to think about that. This is a long-term decision, or at least for a period of time, it's a large financial decision. So you want to think about physically, mentally, emotionally, and financially. Is staying in this home the right thing for you to do? Stuff. What is it? How many of you have stuff? I know many of you do. I have stuff too. What is it? What do I need? What do I do with the rest of it? Is my home an expensive storage facility? And is the thought of the stuff a major demotivator for my plans and goals? I noted here, I've personally downsized and upsized over the last 3 years. And I'll talk about that a little bit as I go along. But I found things to sell, donate, or dispose of with each of the moves, both downsizing and upsizing. And just the thought of, if just the thought of the stuff is getting you stuck, a valuable resource can be working with an organizing service that will help you with this, even if you simply want to declutter and refresh your current home to stay in it. So keep that in mind. There are some wonderful resources here in the local community for those services. Number 3, community. You know, you have neighbors, activities, congregations, associations. One thing to think about are are these ties holding you back from simplifying your housing situation? And oddly, I was talking with my husband about this, and he said, think about, will the people that you're connected to in this community also be making these types of decisions over the next few years and actually making decisions to stay or go? And you may have made the decision to stay and then find you're the only one left in the neighborhood. So you want to have those conversations with people, find out from your clubs, associations, congregations, more about planning for your long-term future on an emotional level and your connections there. And can you find those in another location, or can you find a home nearby that better meets your needs? So again, emotional value, those services, your favorite grocery store, restaurants, the salon you've been going to for the last 15, 20 years, and you have relationships with those folks. As you examine your budget, I know Linda talked about budgeting in the last session and those discretionary funds. Will the use of these services be changing as you are in retirement? Will you be more careful with how you spend your money, and do these services, will they play such a large role in your decision-making process? Then number 5 under emotional value is hobbies and interests. I have golf membership here, but frankly, any sports membership, golf, tennis, pickleball, proximity to cultural events and venues, participation in special interest groups and events, Questions you need to ask are you volunteering in a nonprofit? You can search if you're deciding to make a move or you think that that is a possibility. It's very easy these days to search in advance for similar groups and interests should a new location be a consideration, and should your hesitation only be that you're worried that you won't be enjoying the same types of events, relationships, etc. One thing on golf memberships or any sports membership that you have, if you are considering making a change and moving from the area, you want to start finding out what the specific rules are on memberships and terminating them, because it can be difficult if you have a long-term relationship with a country club. There may be the need to find a buyer for your membership or be on a waiting list until someone comes, a buyer comes available for that. And it can be expensive to wait. So take a look at that as you're moving through this decision-making process. The next note is, or the next value is market value. And for this, I have some information about just the specifics of making decisions on what's my home worth, what work do I need to do, etc. I know Pam Reynolds is going to be talking with you about specifically about work you can do to your home. I just want to touch base a little bit on that and let her fill in all of the major information. But the first question is assessment versus appraisal versus market price. People ask me all the time, does my tax assessment mean anything regarding the value of my property? And the answer is generally no. The tax assessment is a number that the your local government pulls from the air as your portion of contribution to the budget for your locality. So you'll see in many cases that your tax assessment is very different from what you think your neighbors' homes are selling for. And an appraiser won't take that into consideration, nor should purchasers and their real estate agents as they're looking at the market value of your property. Second item here is appraisal. And appraisals are really not necessary when you are considering the sale of your property, unless there are two reasons. But first is, if you've done a lot of renovation and it is very much different from the neighboring homes, you may want to have an appraisal just to get an idea of how it compares to something that your home was like years ago, but you've added, improved, etc. But the one necessary reason is if your spouse has passed away and you need to know what your value is at the time of death to calculate a change in the cost basis of the property. And I think Brian talked a little bit about that in the last session about making sure that you can make that adjustment to the cost basis. So when you do go to sell that property, you know what your actual cost basis is to determine exactly what your tax-free gain might be and also what taxes might be due on that sale. And then the third thing is market value. What is the market price? And that really is determined pretty easily by a real estate professional comparing your property with homes of similar size in fairly close location of recent sales and current competition. Your real estate professional should show you exactly what other homes have sold for and what the people are selling for now. We've had a very rapid increase in price over the last year and a half through the COVID situation. Now it's starting to level off a little bit. What I will tell you is that I doubt seriously that we are going to see a large drop in market value, mainly because most of the purchases, the buyers have invested some good money. There are none of these no money down deals any longer. And so they have less of a risk. There's less of a risk to all of the homeowners in the marketplace because there is more equity in those properties than there were the last time we had the Great Recession. So on number 2, condition, location, and obsolescence. Really, the questions you need to ask is my home in prime condition? Have I kept it up? How does it compare with other similar homes nearby? How old are the working systems? Is it in a, or, is there some obsolescence with the property? Does it need a new roof? Has it gone past the age of the HVAC system being fixable rather than having to be totally replaced? Things like that. So those are good questions to ask. And then number 3, demand. Can it be created no matter the condition, or must I invest in renovations? If there are deferred maintenance items, such as, the condition of wood trim on the house, that wood rot happens to everybody really fast if you're not keeping track of it. Overgrown landscaping, old decor for the home, wallpaper, old carpet, things like that, or obsolete systems such as a roof that needs to be repaired or HVAC system. Your real estate professional can help you determine how to create demand through strategic pricing that will attract buyers who want to make their own changes to the property. And what this does is helps you make that sale without taking money out of the bank to do those renovations. Or your agent can help you with a plan for putting the home in the right condition to achieve top dollar. And again, those resources, there are a number of them available that I can put you in touch with if that is a consideration for you. Number 4 on market value is tax consideration. How much of my proceeds can be tax-free? And you heard from Brian about tax issues regarding the property sale, and the gain exclusion for a single person is $250,000, which is why that appraisal upon death of a spouse is so important. And you can hire an appraiser to recreate a value estimate based on the date of death. It's just more difficult and more expensive, should that be necessary. There are a number of appraisal professionals in the area who are very trained and willing to do that. And then the last thing is proceeds. What do I do with the money if I'm taking advantage of selling it? And I think that is a question that a great one for Linda about what portion do I invest in the next property? What portion do I set aside for long-term income and financial health? And then maybe you use a little bit for a fun vacation. Why not celebrate making a big change? So it is your choice, absolutely. The third issue of value is location. Do I want to live near family, friends, and communities I've built? And a great question about this is to take a look at, are there good housing options nearby that can provide the space and services you desire without losing that proximity to friends, family, and communities? There are a lot of those available in many locations. Number 2, do I feel safe in my current environment, inside or outside? And that's a big question to ask. And I know our next Pam is going to be covering some of that. But the question I would ask is, does a home need renovations to make the kitchen, the bathroom, any staircases more accessible and comfortable for you? And that's on the inside of the property. On the outside, what lighting, exterior maintenance is needed, maybe surveillance or security system. Those Ring doorbells are doing really well right now and helping people feel safer. What do I need for safety and comfort inside and outside of the property? Number 3 on location value. Do I want to be in a different climate, closer to favorite experiences, simplify maintenance and expenses of upkeep? And what I would say is if you are considering a move, how do you find information about your possible new location? Your local real estate professional can connect you with an agent in the areas that are interesting to you, and they can actually provide information, not just about housing, but about services and opportunities in different market areas without having to leave the comfort of your home. It takes a few phone calls and some email of some information, and that can really help you determine how easy or difficult it's going to be to make that move. Number 4 under location value. Do I want to give my current home a makeover and stay in the environment I've created over a lifetime? A lot of people say yes to that and make that choice. And again, our next speaker, Pam Reynolds, will cover a lot of this information in the next segment, making sure the home is right, has all of the right features, benefits, and amenities for you to continue to stay in that location. Number 5, do I want to move and reinvent myself in the new location? How many need a fresh start? Would it be great to be out and making new friends and enjoying the great outdoors in maybe a little bit warmer climate? Just some people, they need that. They need that kick in the butt to get them out and about and learning about new things and meeting new people. So just think about that fresh start opportunity. And then number 6, would I consider renting for a year to explore my long-term housing options and feel confident that the next home and location is a sure thing? I have several clients who've chosen to rent for a year or two and then travel to potential new communities and make an informed decision without the duress of being mentally homeless and making, an expensive and maybe wrong decision because of that mental homelessness. Renting is pretty easy around the area. We have not only apartments, and there are furnished apartments if you choose to put everything in storage or start fresh, but also single family homes, townhomes, and condos available in the market area for that potential choice. So, think about it. Next page is size and use value. And this is one I just went through myself in the last 3 years. How many rooms in my current home do I actually use? I moved from a 4,000 square foot townhouse to a 1,400 square foot rental condo just for that reason, to figure out if I could do it. And I found I needed a little bit larger space, so I acquired an 1,800 square foot space that has all the rooms I used in my big house. I mean, really, how many rooms do you use? I suspect it's the kitchen, family room, master bedroom, maybe a second bedroom as an office, maybe the garage, but how many are just expensive storage spaces? Number 2, how many rooms are reserved for occasional visits by family and friends? Can a nearby hotel accommodate these events if I downsize? I like to tell potential visitors to my area that their guest room is at the Hyatt across the street. So many hotels will negotiate or have rates for local stays. They're less expensive than someone just booking a room off Expedia. So you can always make those phone calls and see if you can work out that type of accommodation. Number 3, how much do I pay every month for upkeep, such as mowing the grass, raking the leaves, shoveling snow, paying for utilities, repairs and replacements of working systems, or am I still doing all the work myself? Oh my goodness. I stopped doing all the work myself and found that I was averaging in that big townhouse over $400 a month just in this category, along with a homeowners association fee. And that didn't include the need to update heating and air conditioning, the roof, appliances, other expensive items in the house. So think about how much you really pay for this on a monthly basis. And then number 4, can I recreate the used space in a more accessible property with modern amenities and reduce the work and expensive upkeep? There are many communities that now offer exterior maintenance, lawn service, and full community amenities for a very low monthly cost compared to what you may be paying to keep up with the home you currently have. And then the 5th value is leverage value. The questions I have, or you would have for yourself, is number 1, do I stay in my home? And do I have the funds in hand to complete the updates that might be necessary? Or does a home equity line of credit allow me to make renovations for future comfort? I would talk with Linda or your financial advisor about that, and also your local banker to determine what monies you need. Do you have them on hand, or would a home equity line make sense for you to make those renovations and then be able to pay that off over time? Number 2, on staying in the home with a reverse mortgage, can my current home equity pay to keep me in it and upgrade without having a monthly mortgage or home equity line of credit payment? And I've worked several times with reverse mortgage professionals, and also, my dad has worked with one and has been thrilled with the results. So if you are looking for this type of a financing avenue, Linda can help you get connected, and so can I. The 3rd item here is moving to a new home. So I've sold my home, I have proceeds. Do I pay cash, 100% cash for the property, or finance a portion of the sale and then invest the rest of my proceeds in a financial safety net? Again, Linda or your financial advisor can help you with this decision. And I can also put you in touch with a qualified mortgage advisor. And then number 4, the reverse mortgage for the new purchase. Can I use a portion of the proceeds to purchase the next home, use a reverse mortgage to never have to make a mortgage payment, and then invest the rest of my proceeds in a financial safety net? All 4 of these you need to discuss with your financial advisor, and I'm sure Linda can help you with that decision. But all of those are just different ways to think about getting either the home that you have in the condition you need to be comfortable there for many, many years, or moving to a new home in an either close by location or some other part of the country, and then how to make that transition be financially viable for you over the long term. So I just want to say thank you, Linda. That's really all I have for this topic today. And are there any questions that anyone has for me?
Pam, I have a quick question for you. One question I get a lot. Can you hear me? Did I get successfully?
Yes,
unmuted?
ma'am.
Oh,
I can.
Is the debate about how much money can I put into my home and still get that out of it? In other words, does it pay to do a renovation? How is there a formula that you use? Is this something that you really need to speak to a realtor about? Does it make sense to enclose my garage? Does it make sense to put in, walk-in showers, things of that nature?
It depends. If there are 2 answers to this. Number 1 is, are you going to live there for a long period of time and enjoy those updates? And if that's the case, the money you put into it is going to be absolutely worth it. You do need to speak with your realtor or with a qualified contractor to make sure that what you're doing is not outside the realm of sensibility, because eventually that home needs to be sold. The second answer is, if you are planning to move fairly quickly after the renovation, you want to make sure that you put your money into the kitchen, the bathrooms, fresh paint, fresh carpet or flooring. Actually, There are a lot of newer flooring options that are very popular. You want it to be clean and presentable, and you'll get the most money out of those changes quickly. If you know that move is going to take place fairly quickly. But again, a real estate professional can help you with those types of answers as well.
Excellent. So that's something you should absolutely have a discussion about before you
Absolutely.
make changes. Perfect.
Yep.
Thank you very, very much. And now we're going to turn it over to Pam Reynolds, who's going to kind of walk us through, you know, what other options that we have if we decide that, you know, we need to make some changes. So Pam, can I turn
Great,
it over to
thank you,
you?
Linda. Let me just make sure I can get my screen up here. I'm not the most tech savvy person in the group, so bear with me here for a second. How's that? Can you all see that?
That's perfect. Great. Thank you.
Yay. Getting on early paid off to work on that. Let me make sure I can scroll through. It'll be the next challenge. So again, as Linda said, I'm Pam Reynolds with currently the law office of Josh Hummer, but we are changing our name on Monday. So the new name of our firm is Atlas Law. So this is the new name and branding here on this presentation. You're getting a little bit of a sneak peek, but that is what we're upgrading to. And I'm here to talk with you guys about basically planning for long-term care. And I'm very excited to be here, and thank you, Linda, for inviting me. So let me make sure I can move the slides here. Yeah, sure can. Great. And then I just need to, I'm not as keen on this as Linda. I'm going to need my notes. So let me switch my screens over here so I've got those. All right. So basically, why plan ahead? When we talk about planning ahead, proactive planning is really the key to aging well. A well thought out plan can give you confidence and peace of mind for the future, and it gives us more options. I often say to my clients that while money gives you options, planning really gives you options as well, regardless of what your net worth is. And unfortunately, people who didn't plan well, whether they have assets or have limited assets, if they didn't set themselves up in a way that protects them and helps their family help them, they still end up in places that they don't want to be, and having very little in terms of choices for their long-term and end-of-life care. And so that's why planning ahead is important. My background is in the long-term care industry. I'm not an attorney. I'm a paralegal now, but I spent almost 20 years in the senior healthcare industry before I made this career change. And I'm here to tell you, 9 out of 10 calls I received when working in that industry was a crisis. I've seen a myriad of heartbreaking negative outcomes for older people, and what it mostly boils down to is lack of planning. And I would get calls, you know, mom's in the hospital, she fell, we have no plan. What are we going to do? Where is she going to go? She can't go home. You know, dad's Alzheimer's has gotten worse. We went and visited him over the holiday weekend, and we just don't think he can live alone anymore. We're scared. What do we do? There's no plan. And getting those calls over and over again when people were just in this crisis mode and no plan and no idea what to do, where things are, how to go forward from here. That's ultimately what led me here to the firm and to this line of work, is because I got tired of being the firefighter. I really want to help people avoid these scenarios. And I'm passionate about helping people create plans that really keep them in the driver's seat even when things don't go as planned. So that is my soapbox there in terms of pre-planning. So what are we talking about when we talk about, let me get over here to change the slide again. When we talk about long-term care. So long-term care, the term long-term care, a lot of people hear that word and they think of long-term care insurance, which is one aspect. But long-term care essentially is the term for care or supervision that's needed for an extended period of time. And generally that's associated with the effects of aging, but sometimes it could be needed temporarily due to an injury or an illness. And so it's not always end-of-life care, long-term care. It can be intermittent. It can be needed more than once in your lifetime. And essentially for long-term care, you really have two housing options. You can stay in your home and do what they call aging in place, or you can choose residential and facility care. And essentially, I mean, most people that I talk to, and my almost 20 years in doing, I worked almost 10 years in residential care, and then I switched and opened a home healthcare company. And in both settings, most people I talked to wanted to stay at home. That was their primary goal. And according to AARP, 90% of seniors report that is what they wish to do. And so in order to do this, they may opt to have care and services come into the home and provide services as you need them in the home setting. And basically there are two options for that: home health and home care. And home health is paid for by Medicare. That's the type of service that if you have an injury or an illness, they will send nurses and therapists and skilled providers into the home to help you get through that scenario. And that's generally paid for by Medicare and other private insurances, but it's intermittent and temporary. It's not a long-term solution. The other type of in-home care is more of the custodial in nature. And that means day-to-day, the type of care that you need on a day-to-day ongoing basis to maintain your living, address the care needs that you have, make sure that you are completing your activities of daily living. So you're able to get dressed and bathe and eat and all of those things that we need to do on a day-to-day basis. And so that is what home care is. Now with residential care, again, I think I need to flip the slide. Residential care, we're talking about, oh, and sorry, there's my slide about aging in place. I got ahead of myself. But again, that's aging in place, home health and home care. Residential care is once you've decided, if you've made the decision that staying at home is not going to work, residential care is the other option. And really there are a ton of different options. You probably think of a nursing home when I mention this. Most people do. Most of the clients I've worked with in the last couple of decades, when they think of moving into a nursing home or a residential care facility, they have a very specific idea in mind of what that is. And it's the nursing homes of the past. There are many, many different options available today. And I'm going to run through a couple of those, or most of those, for you so you just can understand some of the differences here, starting with the lowest level and moving up to the higher levels. So independent living, that is generally the 55 and up or the age restricted communities. It's more resort style living, if you will. Amenities and services are available on the campus. They're available there in the community, but you still have your own apartment, your own condo, your own home. And it makes things more accessible and easier because a lot of what you need is right there on the campus, but no care services, home health or home care type of services are actually included in what you pay. You're just paying a rent to live there on this campus type of setting. And so you have to have a similar plan for aging in place, just like you do in any other residential neighborhood, right? Like you still have to have a plan for supportive care in the home if and when you need it, because it's not included in what you're paying to live there. And then you still have some additional cost, in terms of utilities and taxes and things like that. But what you don't have that you have with a regular neighborhood is the maintenance, right? You don't have to worry about, the lawn care and other things like that. So that's a nice aspect of that. Now, assisted living, that's different. It is much more supportive. So care and services are included, and there's a lot of different models. I mean, talk about different types of facilities within this one category of assisted living, there are probably hundreds of different options and models out there. And here in Loudoun County and Fairfax County in Northern Virginia, we have it all. I mean, there's one on every corner and a lot of different options out there. But I'm not going to go down that rabbit hole and try to explain all those different types to you, but really assisted living has evolved very much over the past few decades, and they've really increased the ability to manage more care needs on site longer. And again, that goes to the aging in place. Like this is for residential care, but it's still this aging in place model. Can we meet your needs as they increase and become more advanced as you age? And that is, the assisted livings didn't used to be able to do that. They had very limited capabilities in managing more complex and advanced care needs, but that has come a very long way. And the next level up from that is nursing homes. And this is what most people do think of when they think of long-term care and residential care. This is the highest level. These are the facilities that are generally funded by Medicaid, Medicare, and Medicaid, and have higher skilled nursing, physician services on site. They're more hospital-like. And they do try very hard not to be and to provide a home-like environment, but essentially that is what you are there for. That's what you're paying for, is to have those higher level skilled services available to you and be able to maintain on site there to have all the services coming into you. So this is often what people think of when they hear long-term care facility, is this kind of traditional nursing home type of community. And then there's also what we call continuing care retirement communities. And there's a new term out there called life plan communities. It's all very similar, but essentially what these are is kind of a combination of all of the above that I just described. So they have the different levels of services all on one campus, so that ideally you buy into it and then you can move through the care services as your needs evolve and change. And these are also drastically changing and evolving their service models, and a lot of different options out there. But really what you're doing is taking, most of the time, people are taking the equity in their home, their largest asset, selling it, buying into these communities on the hope that they will be able to stay there and maintain their care needs ongoing for the rest of their life and have that guaranteed. And then dementia care, I didn't put that on the slide, but this can be offered in any of these settings. And what's really different about dementia or Alzheimer's care is that it's a secure, locked facility. This is something that is higher in staffing ratios and has more specific training on the dementia and Alzheimer's disease state. And this can get very expensive, just in terms of the different types of assisted living out there. Dementia skilled, more focused dementia care is probably the most expensive of all of these options. So those are basically the different types. And again, within each of these categories, there's a myriad of different options out there. So in thinking about what you want to do as you age, if aging in place is what you would like to do, or if residential care sounds better for you, the things that you can ask yourself, as I guess Pam Jones's presentation, the questions you ask yourself, I have this kind of same theme with this slide. Questions to ask yourself are: 1, how will you pay for it? 2, who will help you? And 3, who will help them? And so starting with how to pay for it. Oh, sorry, I skipped ahead. Starting with how to pay for it, I'll start with aging in place, since that again is what most people want to do, and the array of services that are available in the home setting now are greater and more available than ever before. I mean, there's just a ton of services and options out there to help people with this aging in place process. But there are downsides. And one of those downsides is that our homes age with us. And the home that you have lived in for many, many years, it may not be safe for you as you age, or set up in the ideal way for you as you become less functional and your mind and body begin to deteriorate with your age. So as Pam talked about earlier, upgrades, retrofitting may often need to be done to make aging in place possible, and these can be costly and difficult. What's most important is generally main floor living, right? So main floor, bathroom, and bedroom is key. Because stairs become very difficult as you age and very unsafe. And stair lifts are an option. They're not ideal. They are very costly and unsightly and all of that, but they are an option. They can be difficult to install with certain types of staircases, but main floor living is generally the ideal scenario. And with the bathroom, you may need to do shower and bath modifications to make them usable. Having anything you have to really step up over to get into it is going to be difficult. And you may need to widen doorways to accommodate walkers and wheelchairs, and ramps are often needed to get in and out of the home safely with wheelchairs and walkers. And lots of little things, handrails, different locations in the home. You may need to lower countertops, things like that. And so keep in mind, and I think Pam touched on this, that retrofitting can even devalue the home and make it less attractive to younger buyers when it becomes time to sell. And Pam talked about that when it comes to the appraisals. And I'm not a home modification expert, but I certainly do have resources I can connect you with if you're interested in that. My contact information will be up at the end, and I'd be happy to do that. But in terms of cost of aging in place, that is a very big factor. The other factors in terms of cost are maintaining the home, such as utilities, vendors to come and provide, lawn care, housekeeping, different services, the taxes, all of the other costs that you don't have when you are living in a residential care. You have to make sure that when you're comparing the cost of residential care to remaining at home, that you factor and consider all of that in the cost. And then the other cost of aging in place, which I already mentioned earlier, is the home care. So as you age, inevitably, I think it's 79% of people end up using, consuming long-term care as they age. So it's not really as much if, it's more when. It's a very likely that you are going to need that at least at some point. So as I mentioned earlier, custodial home care is not paid for by insurance and Medicare. So the costs are continually rising, and shortages are becoming a problem across the nation as well. So to give you an idea of the cost for long-term care, and of course, pricing varies greatly depending on the type of care, how much you need, and where you are. But the average here in Virginia, and this is based on a study by Genworth just earlier in 2021, full-time, so 40 hours a week of personal care in Virginia is costing clients just a little over $4,000 a month. So $4,004 a month for full-time home care, and that's increasing at 1 to 2% per year. And compared to assisted living, that cost is running about $47,000 per year for an assisted living 1-bedroom. And nursing home is almost double that at $89,000 per year. And those are increasing at about 3% per year. So just to give you an idea of the ballpark costs, and I only throw those out there because I think they're genuinely very underestimated. And do keep in mind, these are the Virginia averages, right? So we're in the DC metro area. We are certainly not in the median of the averages for Virginia. We are always on the higher end and tend to be higher than every other part of Virginia, and higher than most other parts of the country too. So planning for these costs, first you need to understand the need or the risk, and you can base this on family health history and personal experiences. You can get a good idea of what your elder years may look like, and then take that into consideration based on how you want to live. Do you want to age in place? Is this your primary goal? Is this your, at all costs, you are going to do that? Or would you consider assisted living placement? And then think about the support system you have. Is there a good support system that you can rely on, or will you have to pay for care full time? If there aren't family members or other people that can step in and help you, you're going to be paying for more care than if there are. And then as we're living longer and medicine advances, the consequences of living a long life is that you have to pay for more long-term care for a longer period of time. And this is just the way the industry is going. And unfortunately, long-term care insurance, that is one option, but a lot of people haven't bought it. And then even those who have, the amount of care and the time that they pay for it seems to be shrinking. It's not really, but in terms of us living longer and needing care for longer, the amount of time that it's covered isn't cutting it for a lot of people. So in the absence of, or what you should do, and this is where Linda comes in, is have a preferred plan and then develop a financial strategy around that to offset the risk. So Long-term care insurance can certainly be a part of that, but self-funding is important to think about too. And also a well thought out caregiving plan. Again, who's there to support you? What type of care are you going to need and for how long? And then if you're past that point and you're thinking about, well, how am I going to pay for these services? Well, I don't have long-term care insurance. I can't get it now. Then unfortunately, the reality is that custodial care services are out of pocket. You are going to have to pay privately for it. And you can work closely with your financial planner and banker and estate planner and insurance agent, and you should meet regularly and adjust the plan accordingly. And you may have heard of the term Medicaid planning. This is talking about protecting assets so that you're not forced to spend down everything to reach Medicaid asset limits. This is especially when it comes to spouses. So making sure that one spouse doesn't use all the assets before the other spouse has a need for care. This type of planning isn't for everyone, but it can be a very valuable tool if used in the right way. And many people do desire to preserve specific assets, maybe their family home they want to preserve to pass down in the family. So talking in advance with your estate planner is really key in that regard, because the Medicaid look back requirements, which here in Virginia are 5 years, are pretty stringent. There's not a lot you can do to get around those. So, and then the last thing is, or the second thing is, who will help you? So you want to include your family and support members in these plans, and assign a representative who will carry out your wishes in case of incapacity. So you'll need both a medical and a financial agent. These are called powers of attorney, to step in and represent you, advocate for you, take care of these things for you when you are not able to. And that could be, again, that could be temporary or permanent. You could be in a temporary state of incapacity, or this could be something like a long-term, like a dementia or an Alzheimer's. But you do need those agents to step in and act on your behalf to make sure that things go as smoothly as possible. And that's the best way, as I mentioned earlier, kind of keeping you in the driver's seat, choosing those people that you trust that are going to act on your behalf, that you know they know your wishes and are going to advocate for you. That keeps you in the driver's seat by having them step in. And so I'll just touch briefly on how to choose those agents. I could and I have given entire presentations on this, but just a couple of bullet points here. When choosing the people that you want to be in these roles, they should be trustworthy first and foremost. These are people that you are truly trusting with your life decisions. They should ideally be financially independent, so there's not the risk of any type of I don't want to say fraud, but there isn't any risk there that they may not use the funds properly. They should be calm under pressure. They should be able to make decisions under stressful situations. And just bear in mind, they don't have to be the obvious choice. So it does not have to be your oldest child or your sister or whomever you think of first. It really can be anyone that meets this criteria and is able and willing to step in for you. And you can also have multiple people, and you can have layers of backups and plans for that as well. And then the other part of this is not just choosing them, but it's empowering them. So making sure that you get the right legal documents drafted and executed properly to give them the power that they need. You also want to get organized and make sure that they have all the tools and resources that they need. They know where things are, how to get them, passwords, where everything is, who to call. If Linda's your financial advisor, how do I get in touch with her? She's going to know where the assets are, all of that. Having the conversations, so sharing with them what you want and don't want, what you're comfortable with, what your plan for aging is, because if you don't tell them, how are they going to know? They need to have this information so that they can truly be your advocate. And I struggle with this with my own father. Like these, people are just very closed off, very private, and if they don't share the information, the agents get put in a very difficult situation where they don't know what you would want when you're unable to speak for yourself. And that's not a good place to be put in. And then the support team. This leads me to who will help them. And I'm going to move I think I have another slide here. Maybe I don't. I don't. That's my common myth. So I'll leave that up for now. But the who will help them part is another key to empowering your agents and families. So take the initiative now to establish a collaborative team, because the key really is relationships. You want to have community relationships. And Pam talked about this in her presentation, which I appreciated. The community ties that you have are so important when it comes to aging well and ensuring that you remain as independent as possible as you age. So you had a couple examples up there, Pam, but congregation, church, clubs, different organizations that you're involved in, keeping those ties strong is crucial to this strategy. And the other side is professional. So I touched on this earlier with working with your estate planner, financial planner, and insurance agent, but and I'll also add CPA here. I think I missed that one earlier, but your accountant is very important too. And these relationships are crucial to be in place and to be prepared to support your agents when they get thrown into unfamiliar situations. And it shouldn't be transactional, right? Like, it's not enough to just go to an estate planner and draft documents and be done. Like, you need to have these ongoing relationships. You need to be meeting regularly. You need to be keeping them in the loop. You need to be updating your plans, your financial and your legal plans as appropriate and as things change in both your life and the law. And then you want to make sure that your agents are, and if they're not involved in that directly, like they're not coming to the meetings with you, that's okay. But they at least need to know who these people are and how to get in hold of them and what they do for you. And so this is a very important part of empowering those agents and making sure that they can step in for you. And then this is my last slide I already put up here, but this is just some of the common myths that I hear and that people think. And these are some of the things that I think cause people not to plan. They just make these assumptions and they think, oh, Medicare and Medicaid is going to pay for everything. Why do I need to plan for that? And when we talk about the different types of housing and communities, they lump all of them into one category, and they don't think they need to make decisions based on what type of service that they're going to need. The other thing is about the cost, right? So assisted living is cheaper than home care, or aging in place is cheaper than assisted living. Neither of those is true. It's very varied depending on what you're going to need, where you're going to live, and how you're going to receive those services. So you can't say one or the other is going to be cheaper or make your assets last longer. It just doesn't work that way. And then the last one here I'll touch on is I can just hire a caregiver myself for cheaper and do it myself. And I very much advise against that. If you're going to have services and care in the home, using licensed, reputable agencies that have been vetted, that have followed the laws, that can show you their documentation, that is the safest way to go. And that is going to be more expensive, but it is going to protect you in a numerous amount of ways. So I think that's everything I have today. Any questions?
Just fantastic, Pam. We do have a couple of questions. I want to just remind everybody that all of the speakers' contact information was emailed to all of the participants, and all of them have agreed to, just respond to any of the questions that you ask them. You can just contact them directly. Next week, we're going to be talking about mental wellness and health, lifestyle, positivity, and legacies, what we leave to our families. But before I sign off, let's see if we can get some of these questions. Pam, do you recommend resources? Do you have recommended resources that we can find online to research residential and facility care? And then we have 2 on mortgage and a reverse mortgage. So Pam, Pam Reynolds, you want to take that first one?
Yeah, so my first warning would be when you start researching online, you may not even realize that you'll get on lists and you put your information in and then it gets blasted out. So this happens a lot. So just be careful with that. If you go online and, just be careful not to put your contact information in if you don't want to be contacted, because it only takes once and then it gets put on a list and you get contacted by a lot of different companies. I recommend doing a more local search, narrowing down your options, and then checking them out online via the actual State Department websites, right? So the ones that actually do the licensing, the Virginia Department of Health. to see that you can see, it's all public record to see what their ratings were, what they were cited for, if they had problems, what they did to correct it. All of that stuff is online and available through the State Department of Health. And that's really what I would recommend, is going straight to the source in terms of their reputation versus just going by online recommendations or paid advertisements.
Excellent advice. And Pam Jones, you want to slide in here? We are minus 1 minute, but
Okay. No problem. Okay, 2 questions. One was title insurance. Does it continue to protect you if your mortgage is paid off, or is it a waste of money? And actually, it is more important to have once your mortgage is paid off. You have a one-time payment at closing, so you never pay for it again, but it covers you forever, even after you've sold the property, because if there is a defect in the title, the person who makes that claim will go after every owner in that chain. So your one-time insurance premium covers you for the rest of your life. Just hold on to that title policy. The second question is, what is the difference between a home equity line of credit and a reverse mortgage? Home equity line of credit is money borrowed against the equity in your property. And there is payment required. Generally, the limit is 75 to 80% of the value of the property, including the balance of your first mortgage if you have one. You need to speak with your local banker. They're usually the best resource for that. A reverse mortgage is much more complicated, but can also be really beneficial in certain situations. Generally, a reverse mortgage will offer up to you must have 50% equity in the property at a minimum, and they will allow you to put a reverse mortgage in place. You need to be a minimum age of 62, and the payment terms are that there is no payment. Because of that 50% equity, you don't have to make monthly payments, and you can actually receive monthly payments. What happens though is that the loan balance increases, and so your equity over time shrinks. But what this does is it takes away that monthly expense for your housing over your lifetime. Your equity will shrink, and you've got to keep maintain payment of your taxes, property taxes, and homeowners insurance, but you can stay in the home as long as you want to. And upon your death, the house will be sold, the mortgage paid off. If there's still money left, your heirs get it. If there's no money left, there's insurance on the mortgage that covers any shortage that there might be. So happy to connect you with a professional who can tell you more about the details, but my dad is using one and he's thrilled with it.
And I gotta tell you, this was by far one of the best classes I've had. It's just fantastic input from our 2 experts. Again, all of the resources to contact any of our speakers has been emailed to you, as well as any handouts that were forwarded to me by the speakers. So do not hesitate to take advantage of all of us. Thank you very much, and we will look forward to seeing you next week.
And Linda, there's one more question about, should I
Oh.
pay off my mortgage?
Okay.
And I would say, speak with your financial advisor about that.
Yes, there's many considerations there.
Definitely.
Super. All right, guys, thanks very, very much. Have a wonderful rest of your week.
Thanks.
Happy
Thank you.
Thanksgiving. Bye-bye.
Take care.
Excuse me, Halloween.
Halloween. Bye-bye.